Well, good afternoon and welcome to our HiRock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HiRock, who has been swamped with earnings reports this week, but has carved out a little time to give us an update on his 3 top picks from his BNN show a few weeks ago. A little later in our webcast, we'll hear from Paul. Our financial planner, Bianca Thompson, is also on the call. I know that she's been overwhelmed with wealth forecasts recently, but that means that our new clients, and there has been a recent surge of them, are being well looked after. We will have a question and answer period at the end of the call if we have time and I don't talk too much. So if anyone has a question about any aspect of wealth management, we do invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HiRock tab. Okay, let's start by quickly recapping our themes for 2016. Our overriding theme for 2016 is that financial markets will remain volatile. January and early February saw a spike in volatility, but markets have settled thanks to continued monetary stimulus by central banks. However, we are only 1/3 into the year and far from being out of the woods on greater amounts of volatility. There is still plenty of uncertainty left in the world. The big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer has not been providing a significant lift to the domestic economy, as had been hoped for, despite improving employment growth. First quarter of 2016, GDP growth came in at a rather slow rate of 0.5% of growth. Early indicators are expecting the second quarter at an approximate 2.2% pace of growth at this juncture. Our recession indicators continue to show an increasing probability of the potential for a U.S. recession a little bit later in the year. Well, commodity prices, and especially oil, have been trending higher now after a prolonged decline, but that seems to be running out of steam a little bit. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy, leaving inflation-guided central banks considering their next steps. The European Central Bank and the Bank of Japan have pushed interest rates into negative territory to try and get the value of their respective currencies lower and attempt to drive their economies into growth through exports. The Reserve Bank of Australia joined in last week with lower rates. The U.S. Federal Reserve remains on the fence on their desire to push rates higher, at least for the moment. We think that if the Fed does tighten, the probability of a recession becomes almost 100%. Well, geopolitical wildcards like the UK leaving the European Union, the U.S. presidential election campaign, Saudi Arabia, Iran, OPEC and other oil-producing nations, Russia, China, North Korea, terrorist activity and the refugee crisis are all increasing the levels of uncertainty, and it is this uncertainty that will likely create higher levels of volatility to come. We continue to watch the bond markets for clues, and we are almost through the first quarter earnings season and a 4th consecutive quarter of negative growth. The last time earnings growth had 4 consecutive quarters of negative growth was 2008, 2009. We all remember those days. Investor sentiment is low, yet stock markets have moved to within small percentages from their all-time highs, making them, in our estimation, even more expensive. We remain in a time of slower than average returns when after 6 years of above average returns, and as the cycle evolves, longer term returns are moving back toward the average. The total return, including dividends, on our benchmark All Country World Index is about negative 7.25% over the last year. The total return on the Canadian bond index is a positive 3.5% through the same period. So a balanced portfolio of 60% equity and 40% fixed income should have returned approximately a negative 3% over the course of the last year. A portfolio with less equity, say 40% equity and 60% fixed income, should have returned a little less than a negative 1%. Now, a portfolio with a heavy weighting in fixed rate reset preferred shares would be down considerably more, and we'll talk a bit more about those in a couple of minutes. Let's have a look at what has been driving markets over the last week. It was a wild ride in January and part of February, but volatility eased through March and April as the People's Bank of China, the Bank of Japan, the European Central Bank, and the Reserve Bank of Australia all added further monetary stimulus, and the U.S. Federal Reserve lowered expectations for higher rates. But growing uncertainties on many fronts may in fact bring volatility back to life. While volatility remains below its long-term average, and CNN Money's Fear and Greed Index that hit a low near 9 in January, while still now in greed territory after the more stimulant central banks forced money out of low and negative yielding safe assets into riskier assets, it is starting to slip from its higher levels in the 70s that we saw last month. Markets moved rather quickly from oversold to overbought in March. We believe that the next move will likely take us lower. Since our last webinar, our benchmark world index is better by about 0.5% and is now up over 1% on the year. The Japanese Nikkei 225 index was the best performer since last Tuesday. Emerging Markets Index was the worst performer. The TSX has been the best performing country index in the developed world this year. The Canadian REIT Index has also done extremely well. We do have an allocation to the REIT asset class in our global equity model. Well, since the beginning of the downtrend in our benchmark All Country World Index, there have been 2 periods of interim short-term rallies. In both cases, these rallies failed to make new highs, which signals that the longer-term downtrend channel has been reconfirmed, lower lows and lower highs. The next likely scenario will be to test buying support. This could possibly take us to the bottom of the channel, which would be near the 48 level, a further 15% drop. Meanwhile, volume has been higher on the down days than on the up days, which tells us that sellers have more ammunition. Canadian and U.S. government bonds were higher this week as economic prospects dimmed around the Fort McMurray disaster, and as a result, U.S.-Canada 10-year yield spreads widened by about 10 basis points to 43 basis points this week from 33 last week. They were as wide as 95 basis points back in January. The Canadian Preferred Share Index has been a discussion point of late. Paul and I have focused on them in our blogs recently. Now, including dividends, the Canadian Preferred Share Index has returned a fairly hefty negative 15% over the last year, and we do not think that there is much hope to the upside anytime soon. And that is because Canadian banks have been falling behind their U.S. and European counterparts on a key gauge of their strength and will have to likely raise Tier 1 capital to play catch-up. The cheapest way for them to raise capital is through the issuance of preferred shares, and the vehicle that they are most likely to use is the fixed rate reset preferred shares that dominate the Canadian Preferred Share Index. This additional supply will potentially push prices lower again, as from previous experience, demand could not keep up with the additional supply. On the commodity front, copper was significantly lower last week, and now copper is sometimes referred to as a very key gauge for global economic growth. And after hitting bottom in January and trending higher, copper appears to be breaking down through that uptrend. We will have to keep our eyes on what's going on with copper. Meanwhile, oil remains in the uptrend that began in February, but will have to hold the $43 level to remain there. The Bloomberg Commodity Index also continues its uptrend as well, but is off its recent highs. And after touching 80 cents US, the Canadian dollar has fallen off a cliff after the Fort McMurray crisis and now is getting back into greater line with oil prices. Well, our benchmark World Equity Index is comprised of about 53% of U.S. companies, so we do keep a very close eye on what's happening in the U.S. economy, and we think that it is starting to look a bit scary there. We are in a wait-and-see mode to see who becomes the next president, but it does appear that Clinton, for the moment, has a clear lead. And at their latest meeting 2 weeks ago, the U.S. Federal Reserve indicated that it was less worried about global economic issues, but more concerned about slowing U.S. economic growth. Last Friday's data showed that employment growth had resumed its downtrend after a brief up move in March. Well, the past 3 U.S. recessions have followed on the heels of an increase in the unemployment rate that takes it through its 36-month moving average. The rate of decline of the current 36-month moving average, currently at 6%, is fast and steep, and if projected, should hit the 5% level in a matter of months. Even a slight uptick in unemployment from its current level may indicate that a recession is imminent, especially if the U.S. Federal Reserve decides to raise interest rates. We'll talk about that more in a moment. Well, early into the second quarter, the most recent data have expectations for a growth rate of about 2.2%, with an uptick in expected consumer spending and an increased real fixed investment growth. Well, let's have a look at what is happening elsewhere in the global economy. After all the monetary stimulus from the European Central Bank, the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China, the early results are not pointing to any significant improvement. In fact, a few weeks ago, the International Monetary Fund lowered its global economic forecast. As I mention each week, just to keep you all reminded, the Broad and Diversified Benchmark Equity Index, which we gauge the performance of our model and portfolio performance, covers close to 2,500 companies domiciled in 23 developed countries and 23 developing nations. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective. So we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. More than 1/2 of the companies, as I mentioned before, are domiciled in the United States, about 16% in Europe, 7.5% in Japan, 6.5% in the UK, about 3% in Canada, and about 2.5% in China. As for the UK and the Euro area, the most pressing issue at the moment appears to be the June 23rd referendum as to whether the UK will remain in the European Union. As we get closer to the date and the debate rages on, the polls show that it is very close. It also appears that there are now other countries in the EU whose people want a similar referendum. So the potential domino effect is also becoming an issue. So there's some greater uncertainty to add to the existing uncertainties. In China, in April, exports declined by 1.8% on a year-on-year basis, reversing from an 11.5% growth in the preceding month and missing market consensus of about a 0.1% drop. So things slowing again in China. Imports dropped about 10.9%, while markets had only expected a 5% fall. It is the 18th straight month of contraction as a result of declining commodity prices and weak demand. Here at home, following an increase in March, employment was virtually unchanged in April, and the unemployment rate remained at 7.1%. Compared with 12 months earlier, employment increased by 144,000 jobs, or 0.8%, with gains in both full-time and part-time work. Over the same period, the number of hours worked rose by 0.9%. The 12-month moving average, which is that pink line that you see, has been pretty flat since the declines in 2013, so not a lot of employment growth. Provincially, employment declined in Alberta and Manitoba, while it increased in British Columbia and Newfoundland and Labrador, and New Brunswick. There were fewer people working in manufacturing, business, building, and other support services, natural resources, and agriculture. But these losses were offset by gains in wholesale and retail trade, as well as accommodation and food services. The number of self-employed workers edged down in April, while there was little change among public and private sector employees. Today, Stats Canada released a report on capital spending intentions for 2016. Public and private sector organizations anticipate spending about $241 billion on non-residential capital construction and machinery and equipment in 2016, down from 4.4% from 2015. Now that's the second consecutive decrease in annual spending. Spending on both capital construction and machinery and equipment are expected to fall. Okay, well, what do we see coming? And as we do each week, let's go and see what the bond markets are telling us. And as I said, each week we look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the US, UK, and Canada, should give us some hope of better economic conditions in time, as investors want to receive greater returns to protect themselves against future inflation. Negative yields below that pink zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. The Japanese yield curve is now negative out to near 13 years. In essence, you are paying to own the safety of Japanese government bonds, as opposed to them paying you to borrow your money. Not a good sign for the Japanese economy. The US, UK, Canadian, and German yield curves all flattened marginally this week, as economic data suggests that there is renewed concerns of slowing economic growth. Let's look a little closer at the US yield curve. This week we are watching for recession signs. Now, back in 2007, the US Federal Reserve was tightening monetary policy rather aggressively and pushed two-year yields to a point where they were even with the 10 and 30-year yields. And the yield curve looked like the yellow one on this graph at the top there, slightly inverted. So if the Fed does raise rates, or longer-term yields come down, or a combination of both, then the yield curve will flatten. And when that yield curve flattens, that recession will not be far behind. So add that to the current employment or unemployment situation, and we just bring ourselves a little bit closer to a recession later this year. High-yield bonds are lower, and the S&P 500 is a little higher, but one thing is certain: the historical relationship has definitely been turned upside down by central bank monetary stimulus. Investors cannot decide if they want more or less risk on a day-to-day basis, so they jump from one to the other. When the picture is not clear, we think it best to be on the sidelines. As for equity market value, I do really wish that I had something exciting and fresh to add here. Unfortunately, I don't. We are on the sidelines, as I said. We think the central bank monetary stimulus has driven investors into riskier assets, chasing returns and inflating their prices. So we are waiting, and patiently so. When investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. Now, the 10-year average price-to-earnings ratio is at 14.3 times, and the 12-month forward price-to-earnings ratio is currently at an expensive 16.5 times. Now, last week it was at an even more expensive 16.8 times, and back at the equity market highs in May of 2015, it was at 17.1. Now, given the economic circumstances and the uncertainty at the moment, it is hard to justify buying expensive stocks. It is earnings season, as I mentioned, and as a result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is now at a negative 7.1%, which is below the expected earnings growth for the first quarter that we saw at December 31st, 2015 of 0.3%. As I mentioned, it will be the fourth consecutive quarter of negative earnings growth. On average, for all of 2016, analysts are projecting earnings increases of 0.9%. Now, at the beginning of this year, analysts had projected 2016 earnings growth of 7.4%. That is an incredibly steep downward revision and further echoes our concerns at the expensive level of stocks relative to earnings. Often, companies purposely lower their earnings estimates so that when they announce results, they can look like they beat the lowered estimates. On average, over the last 5 years, 67% of companies have beat estimates. Now, we're well over 3/4 of the way into reporting season, and to date, with approximately 87% of companies having reported, 71% have beat estimates. Recent rally in stocks has pushed the enterprise value to earnings ratio higher, back above 13 times and well above the longer-term average. Corporate profitability, which is the white line you see on the screen, tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time. In fact, it looks like an elastic band that has been stretched too far. I know I say that every week, but that's where we are at. The gap between investor sentiment and pricing remains wide. In fact, investor sentiment fell close to its lowest level last week. Now, the contrarians have been busy buying today, but we remain unconvinced. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year. The most recent data show the trend is continuing and keeps us very cautious. Also, when the spread between large cap markets like the S&P 500 widen over the small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. When markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied more while the broader Russell 2000 has lagged. It makes us very cautious. Notice that the volume data here for the S&P 500, greater volume on down days and lighter volume on up days, it means that buyers are not as convinced as are the sellers. What does it all mean? Well, since last May, we've taken a cautious and defensive posture to investing. In light of our key theme for 2016, we remain that way because we see few, if any, good buying opportunities at the moment. We monitor a great many metrics that help us determine where there might be some value, but until we are convinced that there is value, we will remain cautious. Cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, your goals, risk tolerance, and time horizon. However, the ongoing research and analysis that we do at HighRock will dictate minor adjustments in the short-term strategy that we make in our models, which we believe add value to the long-term performance. That is how we justify our fee. On BNN's Market Watch a few weeks ago, Paul identified 3 top picks for our models. You can see the entire show by clicking on the In the News tab on our website or visit the link to the Globe and Mail's Globe Investor article. Our clients will have exposure to these picks depending on timing and value as we see fit, and of course in keeping with your long-term strategy. So I'd like to just ask Paul, if he's got a quick second, give us a little update on any of these top 3 picks of his.
Thanks, Scott. Just really wanted to add 30-year Government Canada bonds. We spoke on that 2 weeks ago on BNN, as you can see on the screen. We did add to that position last week, which probably added about a quarter of what we, or half what we needed to add into our positions. That we picked up about 10 basis points, which is about 2.5 points on the bond. So we had a pretty good entry point. But again, just for our listeners and our clients, these bonds are not necessarily to make huge capital gains on. Government bonds are meant to balance out our risk when we have big risk off periods. Right now we have a risk on period, but these Government of Canada bonds and U.S. Treasuries appear to be doing pretty well. The other 2 picks I won't really go into. Of course, Athabasca is a second lien secured bond, not the stock that we recommended. We bought that bond at $92.25, and it's bid around 93 right now. Conexus, we are waiting any day for the transaction to be approved by regulators in both the U.S. and Canada from Superior Plus, and we've got some embedded value in that one once that transaction goes through, which we believe it will. The only other thing I would add, Scott, is within our tactical model, which you will probably go into in a second, we have about 11 or 12 positions in there, and 2 of those, Athabasca and Conexus stock, are 2 of the 12 positions that we have. So there are quite a few others. A lot of them are very specific and special situation types of position that we put on.
All right, thanks, Paul. Appreciate the update and your comments. I know it adds some value, all the hard work that you do behind the scenes, and we all appreciate it very much. Well, our HighRock models are built to incorporate the need for diversity and balance with fixed income, global equity, and the tactical mid and small cap companies. Because our key theme for 2016 is focused on greater levels of volatility, the cash or cash equivalent component in client accounts, the underweight exposure to equity markets, and the exposure to safe government bond markets, as Paul was just mentioning, helps to mitigate the impact of volatility on our portfolios. Our tactical model has taken advantage of some value purchases so far this year. I know I mentioned them each week, but I will once again reiterate. Rona, we bought before it was taken over by Lowe's at a 100% price increase, and that was great. We also picked up some cheap shares in Paramount Energy before it tripled in price, and we tactically then sold it because it had overachieved at that point in time. And this is all done with a fairly significant cash weighting. As I said, we're still defensive, but this is how we do add value to our and our clients' portfolios and get growth at the best risk-adjusted returns that we see possible, and meanwhile stay ahead of the returns on of our benchmark indices. Okay, well, let's, as we do each week, look and see what's coming as far as economic data next week. Tomorrow we'll get a little insight into what the latest data on industrial production is in the UK. We'll also get EU, European Union, March industrial production. Then on Thursday, as well as we'll get the Bank of England's interest rate decision, which is always going to be very interesting. On Friday, from the European Union, we'll get their first quarter GDP data, and we'll see what the consumer is up to or was up to in April in the United States with retail sales. And some data over the weekend from China, April industrial production and retail sales, and then next Tuesday a little bit of industrial production data from Japan, and of course our weekly HIROC webinar. Okay, well that's it for today's discussion, and we are just within our time limit, so we do have a couple minutes for some questions if anybody has any to ask. All right, no questions this week, but if you do have any and wish to email us, we would certainly be more than happy for you to send them. Remember, there's no such thing as a stupid question, and we will certainly use anonymity if you wish. We do love to get your feedback on these webinars, what you like, what you don't like, what you might like to see us cover. But as always, we do thank you for taking time out of your busy schedules to tune in. Have an excellent rest of the week and a wonderful weekend. Don't forget to tune in next Tuesday. But until then, this is Scott Tomlinson signing off.